Aloha. Welcome to Ably Seminars sessions. Today, our topic will be how to finance a real estate loan. When a borrower borrows money from a lender, there are many sources of funding. And what we call institutional lenders are one, banks. So you go to a regular bank that's either licensed in the state of Hawaii or licensed by federal government to do business in the state where that bank is located. Commercial banks, like Bank of Hawaii, First Hawaiian Bank, or what we call full-service banks. And they'll give you services like checking accounts and savings accounts. But they'll also give you charge cards, do auto loans, and personal loans, and very big mortgage loans. So banks will take the depositor's money and take a bunch of money and say, you're going to borrow $500,000. So they'll take depositors' money up to $500,000 and then loan it to the borrower. And the borrower will then give a mortgage to the bank to what they call hypothecate or collateralize that loan. So that in the event the borrower defaults and the bank has to foreclose on them, that mortgage will serve as collateral to a foreclosure sale, and the banks will then take the money from the sale and hopefully pay back the mortgage. The borrower, when they give a mortgage to the bank, it's called a death pledge. Students of mine have said mortgage in French means a death pledge. So think about this. A person at age 30 might be married, have a child or two, and they'll buy a house. And then when they're 60 years old, they start at age 30, by the way, and for 30 years, they'll continue to make these mortgage payments. And they pay every month for 360 payments. When the 30 years are up, this borrower will most likely retire from work and then be able to pay off the last payment. So when they do that, it's a 30-year mortgage. And that's why they call it a death pledge, which is really interesting that it comes from the French word, death pledge. Loans are usually for 30 years. It could be 15 or 20. It could be an adjustable rate, where the rates go up and down. Or usually, the standard loan is fixed rate for 30 years, 360 payments. So let's say your mortgage payment is $3,000. And in the very beginning, the interest rate is bulk of the interest payment is the bulk of the mortgage loan payment. And a small percentage goes to reduce the principal, the amount that you borrowed. Then every month as you pay down the mortgage, more money will go to pay off the principal and less money will go to pay the interest. And the last payment, and the 360th payment, will be almost all principal and almost no interest. So that's how a self-liquidating amortized loan works. That the payments are steady. It's the same amount every single month for 360 payments. But internally, there's more to principal and less towards interest as the loan gets more and more mature. Now, in the past, they used to have savings and loans besides the regular banks that we know about. And for some of you that are old-timers, you might remember institutions like Pioneer Mortgage or Pioneer Savings and Loan. You might have remembered First Territorial Savings and Loan. Or one of the biggest was called Honolulu Federal Savings and Loan, or otherwise known as HonFed. Over time, for whatever reason, almost all of those S&Ls have gone by the wayside, and banks bought those businesses. Several savings and loan changed the name, like Territorial Savings and Loan became Territorial Savings Bank. And they just got bought out by a company from the mainland called Hope Bank. Then you also had American Savings and Loan, which is now American Savings Bank. So some of these savings and loans switched company or switched their corporate setup and became banks and gave up the savings and loan name for whatever reason. And I'm not smart enough to figure out why they did that. Life insurance companies are another source of loans. So we had the institutional savings or institutional lenders like First Hawaiian Bank, Bank of Hawaii. Then we used to have S&Ls, no longer around. But another big player in the commercial lending industry are the life insurance companies. Now, if you don't know, life insurance companies are full of cash flow. Because think about it. They sell millions of life insurance policies, as these people, while they're alive, are making the premium for life insurance. Then if they die before the payment is over, or before the premiums have stopped, the insurance company has to pay what they call death proceeds from the policy. So now they're collecting all this cash for 20, 30, 40 years. And what do they would do with that money? Because they have to invest it somewhere to make more money to pay the death proceeds. So what they do is they invest. And life insurance companies are a major lender in the commercial world. And they might loan on shopping centers, hotels, office buildings, the bigger projects. And we're talking about tens of millions of dollars, if not hundreds of millions of dollars. So life insurance companies usually focus on commercial loans because they're short-term and they have a higher interest rate. Life insurance companies are also known to buy office buildings or shopping centers. And in Hawaii, there are several major life insurance companies that have bought large buildings, made profit on it, sold it, and I assume that they did a 1031 exchange and moved on to other buildings. So life insurance companies are another major player in the lending industry. So I hope you learned some things about how mortgages work and how lending works. And the major institutional players are the banks and, of course, the life insurance companies. Thank you.